Welcome to HSBC Global Viewpoint, the podcast series that brings together business leaders and industry experts to explore the latest global insights, trends, and opportunities. Make sure you're subscribed to stay up to date with new episodes. Thanks for listening, and now on to today's show.
This podcast was recorded for publication on Thursday, the 2nd of October by HSBC Global Investment Research. Analystifications, disclosures and disclaimers must be viewed on the link attached to your media player.
Welcome to Under the Banyan Tree, where we put Asian markets and economics in context. I'm Fred Newman, Chief Asia Economist here at HSBC in Hong Kong. On today's show, we're catching up on the commodities market with our Chief Commodities Guru, Paul Bloxham, based in Sydney. Prices across the board are broadly flat, but within that, there are a lot of forces at play. What are they and how are they impacting the economy globally and here in Asia, from industrials to oil, gold, grains, and beyond? Let's get the conversation started under the Banyan Tree. So, Paul, welcome to the podcast. You've obviously have followed commodity markets for many, many years now, and you just released also an in-depth report diving deeply into some of the contemporary issues. But before discussing that, I wanted to take a step back, because if you look at commodity prices in recent years, they've actually held up quite well if you compare it to pre-pandemic levels. And that is despite the fact that the Chinese commodity, that's a big consumer of commodities, actually has kind of sputtered along, and yet commodity prices are a lot higher. What do you attribute the fact to that commodity prices have actually held up quite well in recent years?
So thanks for having me on. It's great to be here, and you're absolutely right. They look as though they've held up reasonably well in nominal terms relative to where we were prior to the pandemic, as you say. So I think there's a couple of stories at work here. One story is that, although commodity prices, as you say, have held up, actually, we've had this big surge in inflation, so the overall price level is higher as well. So if you adjusted these commodity prices and compared them to like the US CPI and overall price metric, actually we don't look like we've held up that well. They look basically like they're in line with their average. So what we're saying is real commodity prices are actually broadly in line with their average. They're not a lot higher than they were pre-pandemic. I think then
that's actually an interesting point. I just wanted to emphasize that. So you're saying in real terms, the sticker shock might still be there. Their sticker is still very high. I mean, it seems high compared to where we were maybe 6-7 years ago. But you're saying if we adjusted for inflation, actually commodity prices aren't that high. That would also suggest that maybe they're not really about to fall much further because they're actually, in real terms, are relatively cheap at the moment?
Certainly, that seems to be the case. And it's also, I think, worth keeping in mind that they have actually been broadly tracking sideways for the past couple of years. So, we're in this world where they have tracked sideways, and they've tracked sideways at about their inflation-adjusted or real average level. And so that's right. And that's also the House view, that they'll continue to track broadly sideways for the next couple of years. And the thing that I would throw in next, though, is if you look a little below the surface, you find quite a lot of divergence across the different types of commodities. So certainly this year, the big feature has been that you've seen a very strong rise in gold prices and silver prices, platinum, palladium, a lot of upside to the precious metals. And that's sort of a safe haven flow story. That's money flowing into those things because there's concern about other asset classes and so on. But if you looked at industrial commodities, so oil prices, energy prices, metals prices that are the industrial metals, they've actually been trending lower. So the reason you've ended up with this sort of steady combination of commodity prices tracking sideways has been that the rise in gold has approximately offset the fall in those other industrial commodities.
That,
So
that's
there's a
yeah.
few more stories under the surface.
That's interesting. And I wanted to start with industrial commodities because they are really an indicator of underlying demand globally. And I mean, there's obviously supply dynamics, but really we look, for example, to copper, we look to iron ore as indicators of global economic vitality. What are those particular commodities tell you at the moment?
Well, I think if you look at the metals space, those metals prices have actually held up reasonably well. As we started off the conversation, perhaps it's a little bit surprising how well they've held up, given that it does appear that demand has weakened a bit. I think there's a story here about, well, demand has actually held up reasonably well in the manufacturing sector so far, and a part of that is front loading of activity ahead of the arrival of tariffs. And that's a story I know you've written quite a bit about. And I think that story is also playing through in terms of holding up metals prices in some sort of way. I think the other thing for industrial metals is that actually it is a supply story. We have not been investing in very much mining capacity in recent years. And so actually the supply constraint is one of the features that's holding up these metals prices in a way that might be surprising given the sort of weaker global growth story. And then on energy, well, oil in particular, oil prices have come down. They've been coming down through the year, and that partly reflects a sort of weakening demand story, but it really primarily reflects that there's been more supply added to the global system, and that's partly the OPEC plus story where they had been holding a lot of oil off the global market to maintain prices at more elevated levels, and they've been adding it back in the past year or so, and that's added quite a lot of supply and put downward pressure on prices.
Now, you talked about oil here, and I think that's an interesting indicator because, of course, we look to oil prices as providing a signal to the global economy. Now, as you rightly say, there's supply and demand dynamics. We've seen weaker demand come through. Partly, I would imagine that's for cyclical reasons because the global economy, particularly China, isn't growing as rapidly. But how much is there also a structural story whereby we already see the displacement of oil because of, say, a switch to electric vehicles? Or is that too early to say that yet?
I think it's still too early to see that as a part of the bigger picture story. I think, yes, the China slowdown story is having some impact on oil demand, and that's clear. But I think we're still expecting that we haven't yet gotten to peak oil in China. I think, the most interesting thing in the oil space at the moment is that there is expected to be excess oil on the global market. That's what the team thinks. They think that actually you're going to end up with excess supply. And the big question at the moment is that excess supply at the moment is getting absorbed by China stockpiling. So they've been ramping up their inventories onshore, rebuilding their strategic reserves and continuing to do that. So they've been acting as a source of demand in stockpiling. And how long that goes on for is the really outstanding question at the moment. And the oil team's grappling with that, about whether that, if that were to slow down or stall, then that would put further downward pressure on oil prices. So we've got a working assumption that oil prices are $65 a barrel next year, but we've got a downside risk because we think, well, the demand side's weak, the supply side's ample, and we're really reliant on this stockpiling story in China to continue to support the price.
If I kind of summarize, and correct me if I'm wrong, if you look at industrial commodities, but also the oil market, you seem to suggest that there are still downside risks. We talked about front loading, kind of flattering demand a little bit for industrial commodities. That, of course, could start to break away as we sort of see a payback for the front loading. And then you also hint at more supply coming on stream in the oil market. And unless we get a big underlying demand resurgence, because China cannot stockpile oil forever, is it fair to say that there's a risk here of demand weakening in the coming quarters and therefore prices declining?
That's right. I mean, that's the assessment. We come to the view that although our central case is commodity prices track broadly sideways, that there is downside risk to that. And that's partly due to an expectation that global growth is going to slow. And that's partly the front loading story rolling off, as you've described. But it's also a supply side story where, particularly for energy, we've got ample supply of energy. I mean, there is more oil coming back into the system from OPEC. As I say, the team is expecting there's going to be a surplus in the oil market. And then on the gas front as well, I think, the supply side story on the energy front in particular gives you more downside, and the demand side story from the global growth story also gives you some downside. So yes, downside risk to our commodity price forecast.
So you broadly paint a picture of maybe mildly disinflationary trends in global commodity markets, which is obviously positive for consuming economies and helps the broader disinflation process. And maybe that's a good time to take a quick break, because when we come back, I want to ask you how geopolitics, the trade war, geoeconomics fits into this, and how that maybe makes the job harder of predicting where commodity prices are going. Well, welcome back. Before the break, we kind of talked broadly about commodity market trends and whether you look at industrial commodities, oil markets, or agriculture, there's still mildly disinflationary trends building up, particularly if you assume that the global economy continues to cool in the coming quarters. But, Paul, I wanted to ask you really about a political angle here, because we've seen, obviously, tariff tensions build up. We see geopolitical tensions build up. We see this rise of geoeconomics, which is really sort of subsuming economic policy to geopolitical imperatives by many countries. What does all these geopolitical developments mean for how you think about commodity markets?
Well, this is certainly something we've observed, that this is playing an even bigger role in recent times with the Russia-Ukraine war, and then, of course, all the developments with trade policy coming out of the US and what that means. And you really can see it in commodity markets. So one of the things we work through in this report is to observe that commodity markets have become more volatile. The cycles in commodity markets appear to have become a bit shorter in recent times if you compare them now to what they were like just a few years ago. And you're also seeing increased fragmentation. And what I mean by that is you think of the law of one price, where you think that a commodity or any particular thing might have one price across the world. Well, that's not necessarily the case. You sometimes get markets where the price of copper, for example, is higher in the US and lower in other parts of the market. The fragmentation of markets has increased a lot, and we've seen that really observed just over the past year in things like copper, for example, where the price in one market is different to a price in another market. So yes, this concept of sort of geopolitics having a bigger effect on the economy and foreign policy having an impact, sanctions and the like having a big impact on the way commodity markets work is leading to this. Now, as you alluded to, this is making it much more difficult to pick out sort of trends in commodity markets. It means you're doing a lot of reporting of the things that are going on as they happen, but it's difficult to pick the direction of trends because this is driving things more so maybe than it has done in the past.
Yeah, let me follow up on this. So you're saying it's harder to predict the trends. That's obviously intuitive, quite understandable. We also see fragmentation of markets. We used to talk about broad commodity cycles when global markets were integrated. They followed obviously global demand trends and some long cycles. Is that still the case, or does the fragmentation, the political angle, kind of disturb the broad cycle? Does it make harder to kind of predict prices 6 to 9 months out, maybe compared to a decade ago?
I think it makes it much harder. And one way we did this in the report is the team that we work with, the data science team at HSBC, puts together this sophisticated machine learning statistical tool where they track lots of commodity prices and they look for the trends in each of the individual, just the prices, no other inputs, just the prices. And this model that they've been running now for a few years is typically used to try and pick whether we're in an upswing or a downswing or whether we're in a super cycle and so on. But it's really struggling at the moment. It was doing a better job in years gone by of sort of being able to pick out these cycles, but just a pure statistical look at the numbers, it's finding it very difficult to confidently pick where we are. And what's interesting is that really started to break down around 2022, around about when the Russia-Ukraine war started, and actually it's really broken down a lot more since the second Trump administration has arrived, when we've gotten these very big shifts, quite volatile shifts in trade policy coming out of the US. So yes, it is getting harder, I think, to be able to pick out those trends, and we can say that not just with a casual observation, but we can look at a thorough statistical model that kind of tells us that's the case.
That's interesting. So we have evidence that the cycle is becoming harder to predict. That's partly a result, presumably because of the fragmentation of markets, the rise of geopolitics. But why would that matter for the average company, for average growth, if you have more unpredictable commodity prices? I would imagine in part it makes it harder to plan. It raises costs in terms of hedging. It raises uncertainty. Uncertainty is always bad for investment. Is it fair to say that this is kind of part of the headwinds for the global economy? It's yet another example where uncertainty just becomes a headwind to economic growth.
I think that's absolutely right. I think, this is one of the ways I look at this, is that shifting policy rapidly, substantially, in a way that's unpredictable creates uncertainty. Uncertainty is not good for growth because, as you say, it's very difficult for businesses to make long-term decisions about investment and hiring and how they're going to manage their inventories and their systems and so on. I guess what the commodity space, there's a direct implication, which is you're seeing it in the commodity markets, which is obviously a big input into production for lots of firms. And so that makes it more complicated and they potentially have to do more hedging and so on, as you describe. But I think also in some ways, the commodity markets themselves are giving us an example of where it's evident, where you can see this uncertainty having a bigger effect on different prices and fragmenting markets. And so it's a useful way of sort of tracking and illustrating that we can see the impact of this uncertainty in markets and in key inputs into production.
Paul, this is a very illuminating discussion, but I'm just reminded you put two economists in a room to discuss trends, and we're left with two conclusions here, one good, one bad. The good conclusion is cheaper commodity prices, mild deflation should be a tailwind for consumers of commodities going forward. That's positive. But the negative is that commodity prices have become more unpredictable, and that uncertainty in itself then is a drag on growth rather than something positive. So thank you for all these thoughts, Paul, and I'm sure we're going to check back in with you because, as you rightly say, and the big report you recently released clearly shows commodity price volatility is here to stay, and that's partly a reflection of the broader geopolitical uncertainties that we've seen. So thanks for joining us, Paul, here under the Banyan tree, and talk to you again soon.
Thanks a lot.
And that's all we've got time for today, folks. Great having you with us, as always. Under the Banyan Tree is an HSBC Global Investment Research production, as is our sister podcast, The Macro Brief. You can listen, like, and subscribe to both wherever you get your podcasts. Thanks, as always, for listening, and we'll be back again next week.
Thank you for joining us at HSBC Global Viewpoint. We hope you enjoyed the discussion. Make sure you're subscribed to stay up to date with new episodes.